markets finally take a little bit of a breather on what is a very slow day for Wall Street. There's perhaps something to be said for a lull in U.S. economic data and screaming tariff headlines to motivate volatility. But there is something that seems to be bubbling under the surface in global economic data that is perhaps shaping up to be a greater spook for financial markets as we look ahead. We're seeing some interesting data come out here over the course of this week, and some more interesting data that's coming up in the coming days, and indeed even just in the next 24 hours, that start to warn that after a protracted slide in global inflation rates, after global central banks, led of course by the Fed in 2022, went on a tear raising interest rates to put post-COVID inflation back into a box, that something seems to be perking up again. And it's happening at the worst possible time for economic growth. So we started this week with Eurozone inflation data, which at the surface seemed like it gave us a second consecutive month of 2.2% inflation. Not immediately something you might start to get concerned about looking at it, but it is the first time in some months that inflation didn't fall. So perhaps that's interesting. The first time in 3 months, as a matter of fact, that it held steady. But it isn't so much this that grabs the attention. It is that looked at through the lens of core CPI, where you strip out the influence of food and energy because they're set on global markets and generally relatively volatile, so the central bank doesn't really have much agency here. There's been a jump to 2.7%. A significant increase, needless to say, from the 2.4% in March, and back basically to the starting line at the end of last year. When you look at what happened here, and you look at the internals, what you see is there was a significant increase in food prices. There was a significant decline in energy prices. And in fact, this decline was larger than this increase. So when you looked at the headline, you got to 2.2% because this move here was enough to offset what happened here and here. But when you take this away and you take this away, what you're left with is this increase in service sector in inflation. As a matter of fact, of the 2.2%, 1.8 percentage points was services, and most of that was right here in hospitality, which may be just the knock-on effects of higher food prices that appear not just at the immediate level, but in terms of the price of services that use the materials. And so you get a sense that maybe what's going on here is some sort of a knock-on effect that then shows up. But what you end up with ultimately is inflation that's going in the wrong direction. Then earlier today, you get Canadian inflation data, and again, at the headline, you get a dramatic decline. In fact, the lowest since September of last year. It's a little bit warmer than expected. The expectation was 1.6, which tells you that the market was completely ready for a big drop in headline inflation, and that's, of course, because of a huge decline in the cost of energy. Again, this time amplified to the nth degree by the scrapping of a consumer carbon tax as of April 1st in Canada. So these numbers were skewed by that. But again, you look at the core, and inflation is rising. It's even more dramatic if you look at the core version that the Bank of Canada likes to use. This one, as is traditionally the case with core inflation, strips out energy and food, and in Canada's case also mortgage interest payments and a few other things. But when you look at this trimmed mean version of core, where instead of cutting away specific sectors. You just cut away the extreme spikes up or down, no matter what sector they're in, to try to get at the central tendency in prices. And what you end up with is the highest inflation in 13 months at 3.1%. And the trend, of course, isn't particularly helpful. It's no surprise then that when this data comes out, despite the huge downswing at the headline, again, we just saw it right here, Canadian interest rates go up when the data comes out, and you can see it in the Canadian dollar, which, with the release of the data, spikes higher, and after some digestion, ultimately resolves its way with some marginal gains on the day. But here's where that data comes out. The market clearly is looking at the higher core readings and not the very widely expected distortion at the top. And there's the numbers we've just seen out of the US. Now, the market, of course, got very happy with the idea that this was generally a normal CPI report in April. Most of the inflation showing up in services as before, but perhaps most importantly, there is no great surge in goods inflation, which you might have expected was a risk with all of the tariffs that we've seen flying back and forth. Food is ultimately about the same contribution as it was in the prior month. So is energy. No big changes there. This, though, taken to be an encouraging sign that the tariff war isn't punishing consumers. But then, of course, we got the PPI data. And when you look at what happened there, it's this shock month-on-month decline. And when you look at where that month-on-month decline came, we can clearly see that, first of all, when you get down into the core, you still get a decline. So it's not food and it's not energy. It's not some sort of idiosyncratic factors like that. And when you look at goods inflation, again, wholesale, it did in fact rise, and it rose by the most month on month in, give or take, 2 years, a little bit more. So the goods inflation is there. What is masking it is this dramatic decline in services inflation. And what you find there is a 1.6% squeeze, which is very sharp for a single month, on trade services costs. That the margins there got squeezed by almost over 1.5%, let's say. Let's not round all the way to 2. Over 1.5%, which is a very, very significant change for a single month. And what that's telling you is that businesses are insulating consumers from rising tariff costs. They are essentially saying, yes, the tariffs are creating inflation. It's just we as businesses are going to, for now, bet that this is not going to be a lasting thing, and that we don't want to lose market share by raising prices on consumers, so we're going to eat this difference for now. Now, we just had corporate earnings reports from, say, Walmart and Home Depot. Walmart said they will pass on the extra cost of tariffs. Home Depot said that it's going to keep eating it for now. We're going to get earnings from Target and Lowe's coming up this week. We'll see what they say about this. But clearly, the macro level insight here is that this is something of a mirage. It's not showing up in consumer prices because businesses are eating it. That doesn't mean it isn't showing up. And so there is inflation seemingly percolating in the US as well. Now, in the coming hours, we're going to get an inflation update from the UK. And here, we're actually looking for quite a significant jump in price growth. The headline number expected at 3.3%, which would be the fastest since February 2024. The core level seen at 3.7%, which would be the highest in 4 months. 3 months, let's say. Now, what's interesting is we just had a Bank of England rate decision. It was a cut. And what we find is that since that rate decision, the actual curve in benchmark SONIA futures that anticipate where policy will be heading became a little bit less dovish. So here was the curve at the meeting. Here's where it's moved now. So rates are seen a little bit higher now by year end than they did here. Moreover, we can see that this is a little bit more of a dovish setting than what was there at the middle of March, so almost exactly 2 months ago. And the upshot here is that the amplitude of speculation has really narrowed. We're kind of in this narrow space here where it looks like expectations are relatively well anchored, and though the Bank of England cut last time, scope for ongoing easing seems relatively mild. Again, this was the same story as we got from the Bank of Canada today. Headline inflation was weaker, but we looked through that to the pop happening in core, and what do we get? Higher yields. Less scope for Bank of England rate cuts, not more. What have we been talking about with the Fed? Policy expectations there have unclenched. We are now back to basically 50 basis points for this year, 50 basis points for next year, in line with Fed expectations, whereas at the peak of the panic in April, we were looking at something closer to 140 basis points this year and next. So we've shed nearly 2 rate cuts. And so the story seems to be that inflation is starting to pop up in market after market, in country after country. It seems to be starting to happen at the core level. So it's not the kind of one-off thing that you can write off, dare we say, as transitory. And that all of this is happening is understandably pushing central banks back in their intent to cut rates, or at the very least anchoring them in place. As a matter of fact, the Reserve Bank of Australia just cut rates overnight, but the Australian dollar couldn't really sell off on it in any kind of a lasting way, just stuck inside its range. The central bank lowered its growth and inflation expectations, which is why the Aussie did anything, it would seem, because of course the cut was widely expected. But the language from the RBA clearly signals this is not a cut that is a response to negative economic conditions. This is a maintenance cut. We'll see if we need to do more, but we are now well positioned to keep inflation as our main focus. And so, again, you have a central bank that's acted, but that looks reluctant to go again. And what makes this such a difficult backdrop, rising inflation and reluctant central banks, is that on the growth side of things are actually deteriorating. In April, as we've talked about before, we have this global PMI reading from S&P Global and JP Morgan. As ever, these are in terms of a diffusion index where 50 is neutral, above 50 is growth, below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. And so looking at this composite index here in the blue, what you see is that since early last year, the trend for global growth has been deceleration. And it's been deceleration to a point where, as of April, we've landed on the weakest performance for global economic activity growth in 17 months. We're back to here. Now, on the manufacturing side, there's been a little bit of a pop from late 2024 heading into 2025 around the front running of tariffs. This makes sense, of course. If you know as of November that Donald Trump will be the next president of the United States and he's spent the better part of 2 years campaigning on tariffs, among other things, of course, but certainly loudly campaigning in favor of tariffs, well, you may not know what's going to happen with those tariffs at that point, but you do know that if you can build up inventory at the old tariff prices, U.S. tariff before all of this was on average 2%, well then sure, you're going to go do that. You're going to max out your orders and you're going to squeeze in as much as you can. So it makes sense that there's a pickup in global manufacturing activity against this backdrop, but that seems to have run aground already. Already come March and April, as a matter of fact, it seems like that influence has faded. But the decline in services, that continues. And it's taking the overall pie lower. Now, it's not difficult to unpick which part of this is the culprit. As we've said many times here before, global growth is really contingent on just 3 economies: the US, the Eurozone, and China, which collectively make up 58% of global GDP. And moreover, the remaining 42% are mostly vendors to the former 3. So think Canada and Mexico with the US. Think Central Europe, Nordic Europe with the Eurozone. Perhaps to some extent even the UK. Think commodity producers from Latin America to Africa to Australia for China. And of course, most of Southeast Asia. So these are the 3 economies that really drive the engine. And when you look here at what's happened over the course of last year going into this year, is the story in the Eurozone and China has been becoming increasingly more anemic to a point where, again, this is in PMI terms, they've converged on 50. So standstill. We have both versions of China's PMI data here, the official version, CFLP, and the S&P Global version, which matches the ones from the US and the Eurozone. Both of those are the S&P Global numbers. And you can see here, all of it is telling the same story. The pathway is a little bit divergent in spots, but we've come down to standstill pretty much all around. And the real major change that's occurred here is that the US numbers, which were very strong up until the end of last year, they've fallen off and they're converging on the same standstill that everybody else is experiencing. Then, of course, comes the most uncomfortable question of all. If growth is slowing, who is coming to save it? Because if inflation is rising at the same time, and central banks are reluctant to act, well then they're not going to ride to the rescue until something so untoward occurs that they have to come and chase it. That, of course, puts the current macro backdrop into quite the dangerous setting. Because what it means in practice is that central banks don't want to cut rates. Fiscal authorities are not really in a position to act quickly and aren't really the vanguard of being front and center on making painful economic decisions. Meanwhile, the backdrop is creating that scary divergence in growth and inflation that gets everybody whispering stagflation, and for good reason. It is a very difficult policy environment to navigate. Now, we're going to get an update on PMI numbers later this week, and we'll talk about that in detail tomorrow as those numbers draw closer. But if we get another similar story here from UK CPI, as we've now seen from the Eurozone and from Canada, and albeit with some smoke and mirrors in the US, then the overall picture is going to start looking increasingly defensive, at least as far as the backdrop is concerned. Going into these PMI numbers that ostensibly will show, and those are the expectations, that global growth remains in very much a defensive mood. Now, whether stock markets and other markets are prepared to care about this, that's another story altogether. But the evidence that something that is both recessionary and perhaps inflationary is becoming increasingly apparent, that's a gathering risk. And it seems a matter of time until the markets come to focus there. This is Macro Money for today. As ever, we are here right after Overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I'm back with Victor Jones in just 30 minutes time today for the price of truth. I'll be back with Chris for Futures Power Hour on Friday, and then back on Monday as I am every week. I'll be on with Victor for First Call alongside Tom on Sundays, writing for the News and Insights portion of tastylive.com, and commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. As ever, if you're watching on YouTube, like and subscribe. Macro Money's back tomorrow. Happy trading.